Hi everyone, welcome back to Economics per se. We're going to finish topic 1 today, which is national income. In this video, we'll finally be looking at what brings the supply and demand for goods and services into equilibrium, and we'll also look a little at the effects of fiscal policy on savings and investment demand. There are two ways to think about the role of the interest rate in the market. We can consider how the interest rate affects the supply and demand for goods and services, or we can see how the interest rate affects the supply and demand for loanable funds. We will see shortly that these two are actually the same. So first, let's look at equilibrium in the market for goods and services. You would remember these equations. First of all, we had our y is equal to c plus I plus g. Still no nx at the moment because our economy is closed. Second, we have our consumption function, where consumption depends on disposable income, y minus t. And then we have our investment function, where I is a function of r. And also, if you remember, we have our government expenses and our taxes, which we took to be given or fixed because they are set by fiscal policy. So first of all, we have G, which will be denoted by G bar because they're fixed, and T, which will be denoted by T bar. We also saw that since the supply of our factors of production were fixed in this model, our output would be fixed as well. So that would mean where we had Y as a function of K bar and L bar, since these two factors of production are fixed, our output Y is also considered to be fixed. Now what we do is that we substitute all these terms that we defined right now into the national income accounts identity, and we will get something like what we had was this. So this would turn into Y bar being fixed, and C is equal to C of Y minus T, both of which are fixed, plus the investment function, plus G bar. This equation here states that the supply of output equals its demand, which is the total of consumption, investment, and government purchases. We see that R here is the only variable not already defined, and that's because the interest rate has a very important role to play yet. The interest rate must adjust to ensure that demand for goods equals the supply. If the interest rate is high, then the level of investment will fall and the demand for goods and services will fall. If it's too low, then the level of investment will increase and so will demand. At equilibrium interest rate, the supply and demand of goods and services must equal. But how does the interest rate get to that perfect level? To answer that, we must look at equilibrium in the financial market, where we study the demand and supply of loanable funds. Now, since the interest rate is the cost of borrowing and the return to lending, we must look at the national income accounts identity from the financial markets point of view. To do this, we must rewrite the identity to isolate investment. So what we had was Y equal to C plus I plus G, and this will be now written as Y minus C minus G being equal to I. Y minus C minus G is the output that remains after demand of consumers and the government has been satisfied. This is called national savings, or simply savings. So in this form, the national income account identity shows us that savings is equal to investment, or S is equal to I, this being S. We can further split saving into private savings and public savings. So S would be equal to Y minus T minus C plus T minus G equal to I. Y minus T minus C is just disposable income minus consumption, and it's private savings. T minus G is government revenue minus government spending, which is public savings. To see how the interest rate brings the financial markets into equilibrium, just substitute the consumption function and investment function into the national income accounts identity we rewrote actually. So since y is equal to c plus I plus g, which was what we first defined, this actually turns into this one right here, y minus c minus g being equal to I. So y is y, right? Output is output, and c now turns into the consumption function, which is y minus t minus what is g? G is still g, it's fixed, right? So these are also fixed actually, and this gives us the investment function. So what we just did is substitute the consumption function and the investment function and government expenses into the accounts identity. So since all of these are fixed and these are equal to S, this means that savings is also fixed. So savings is equal to the investment function. The left-hand side of this shows that savings depends on income, right? And the left-hand, savings depends on income and the fiscal policy because G and T also plays an effect here. And the right-hand side shows us that investment depends on the interest rate. Now let's try to draw a graph here. On the x-axis, we will have investment and savings, and on the right axis, we'll have the interest rate. First of all, let me draw the curves. This is going to be savings, and this is going to be investment, and the interest rate. We have the interest rate on the y-axis, savings on the x-axis with the investment. Savings curve is vertical because saving in our model was fixed, right? It did not depend on the interest rate. We'll relax this assumption later. The investment curve slopes downwards because of its inverse relationship with interest rates. The intersection of these two curves determines the equilibrium interest rate. Now, you might think, does it look like a supply and demand curve? You can think of it that way, but the good demanded and supplied here is called loanable funds, and its price is the interest rate. Savings is the supply of loanable funds, where households lend their savings to investors or deposit it in a bank who lends it out. Investment is the demand for loanable funds. At equilibrium interest rate, people's desire to save balances the firm's desire to invest, and the quantity of loanable funds supplied equals the quantity demanded. Let's now look at something really interesting, the effects of fiscal policy on everything we've discussed. Fiscal policy is simply the government's plans on spending and taxes. When the government changes its spending or the level of taxes, it has an effect on the demand for the economy's output and alters national saving, investment, and also the equilibrium interest rate. Say, if government purchases increases by an amount X, the immediate impact is to increase demand for goods and services by X. But because total output is fixed, because factors of production are fixed, the increase in government spending must be met by an increase in some other category of demand. Disposable income, y minus t, is unchanged, so consumption is unchanged as well, right? Therefore, the increase in government spending must be met by an an equal decrease in investment. To make investment fall, the interest rate must increase. So the increase in government spending causes interest rate to increase and investment to fall. Government spending is said to crowd out investment. So let's see what this means. Again, our graph, x-axis has the savings and the investment, and y-axis has our interest. An increase in government spending means a fall in national savings because although private savings remain the same, public saving falls. A reduction in national savings is shown by a leftward shift in the savings curve, which is the supply of loanable funds, right? So we have our investment right here, and this is our savings, and this is our equilibrium interest rate. But when national savings falls because of the increased government taxes, which decreased public savings, our savings falls. Let's call this as 1R1. So what happened here? A reduction in the national savings, leftward shift in the savings curve, which is the supply of loanable funds. This leads to an increase in the interest rate from R to R1. The new equilibrium is where the new savings curve and the investment curve, they intersect. In sum, an increase in government spending is said to increase the interest rate. Well, now try to figure out what happens yourself, stepwise, to the interest rate when government spending decreases. All right? Similarly, a decrease in taxes would lead to increased disposable income, which would lead to increased consumption. This would lead to a decrease in private savings, and so a fall in national savings. A fall in savings means, again, a leftward shift in this diagram, and so an increase in the interest rate again. So far, we've talked about how fiscal policy can affect national savings, but we can also use our model to explain the demand for investment. Let's talk about a few reasons. One reason investment demand might increase is increase in technology. For example, what use are roads if there are no cars? And what use is the idea of a car if there are none produced? Producing cars means investment in its manufacturing process. Technological innovation leads to increased investment demand. And another way to increase investment demand would be because the government encourages or discourages investment through tax laws. Think what would happen if the government increased personal income tax and used that to implement tax cuts for the firms. The firms use that extra revenue to invest in research and development. Investment in such projects would be very profitable for the firms. Let's try to look at it on a graph. An increase in investment demand would shift the investment curve to the right. Now, with the shift in the investment curve to the right, I1, at any given interest rate, the amount of investment is higher now. The equilibrium point moves as well, right? From R to R1. However, since the amount of savings in our model is still fixed, the equilibrium amount of investment is still the same, say Q, although the interest rate has increased. Now, having said that, think what would happen if we allowed consumption to be dependent upon the interest rate. Since the interest rate is a return to savings and the cost to borrowing, a higher interest rate may decrease consumption and increase savings. If this were the case, the savings rate would be upward sloping. Okay. When savings is positively related to the interest rate, savings curve would be upward and positively sloping, and the investment would be the same. Right? Just like that. Let's say that there's a rightward shift in investment because there is some technological innovation in place, I1. Now, this would increase the interest rate and the amount of investment as well, right? This was the interest rate before, and it increased to R1. This was the quantity of investment before, and it increased to Q1. The higher interest rate encourages people to save, which in turn allows investment to increase. And now, with this, we end our topic of national income. Here, we developed a model that explains the production, distribution, and allocation of the economy's output of goods and services. But remember that the model relies on the classical assumption that prices adjust to equalize supply and demand. Our model is also sometimes called the general equilibrium model. Some assumptions we held were that we ignored the role of money. In the next chapter, in the next topic, we'll include money and monetary policy in our discussion. We assumed that there were no international trade. In topic 3, we will open our economy to the world. We assumed that there was full employment. In topic 4, we will bring unemployment and public policy into play. We assumed that the factors of production were fixed. In chapter 2, we will see how labor, capital, and technology grows. And finally, we ignored something called short-run sticky prices. In chapter 3, we will develop a model of short-run fluctuations, which will include sticky prices as well. So now we have a lot to do, and I can't wait. I hope you enjoyed this video. Please leave a like, maybe subscribe, and see you soon.